Nick, good to have you back here on the final episode of Private Equity in the Pest Control Industry. This episode is going to be largely a summary. I want to talk a little bit about some of the things that we didn't talk a whole lot about before, and that's returns. Returns on equity investments and so on and so forth. But before I do that, I have received quite a few questions from listeners out there, and I think after this episode, Nick, it'd be great if you can join me back and help me answer some of these, because some of these really will need your help. We've received some questions on some of the tax implications of doing these sorts of transactions, thinking about how rolled equity and tax implications on that in the future. So I'd love to have you back. For those of you who do have questions, send them to PE, that's PE, at potomaccompany.com. The email address will be in the comment section below. You can send us an email and we will read it here. But in order to kick this off today, Nick, I want to talk about how private equity firms think about economic returns, right? They're investing cash today to ideally yield more cash in the future. That's obviously applicable to any sort of financial investment in any market. And so maybe you can kind of kick it off for us today and just talk about returns on investments.
Thanks, Paul. So to take a step back, private equity firms, they have clients. Just like I have clients, just like you have clients, and just like pest control companies have clients. Mm-hmm. So as private equity gathers this capital from their clients, they go out and they try to earn a return. Mm-hmm. And a mid-market private equity has return expectations anywhere from 20 to 30%. Okay. Yep. And the way they typically measure that, it will be a 20 to 30% IRR, or internal rate of return. Okay. And if they have this 20 to 30% internal rate of return, there is also an expectation of how long their clients will actually generate that return. So let me give you an example. Let's say you have a private equity fund that takes in capital from a large institution, a big pension fund, endowment, et cetera. And then they go out and invest this capital and earn a 25% internal rate of return over 5 years. That would effectively turn $1 that their clients are investing with them into $3 over that 5-year period, which would be a highly favorable outcome, or even in line to slightly above the return expectations of their clients, okay? So that's sort of the first high-level aspect of returns and generating returns as a private equity firm. But when you think of how those returns are generated, any investment, this is applicable to stocks, this is applicable to fixed income, this is applicable to real estate investments. There's a few different components of a return. And Paul, you and I have talked about this in the past. It's really, you can generate a return from the cash flow or the income that you're getting on a periodic basis from that investment, whether that's dividend payments, it could be coupons from a government bond, it could be coupons from a high yield bond. The list goes on, but receiving cash on a periodic basis is one way to generate a return. Yep. The other way to generate a return is through capital appreciation. So you buy something for $100, it appreciates to $300, you sell it, you pocket the difference, and that is your return, okay? And so when private equity thinks about returns, it's typically the latter, meaning they're targeting capital appreciation. So they're going out, buying a platform pest control company or a larger pest control company, buying add-on acquisitions within that. And we talked a lot about this in the last episode, Paul. You went through some great examples there. But ultimately what they're doing after making those acquisitions, growing the enterprise, cutting costs, and then hopefully selling for a higher multiple, they're effectively generating their return through capital appreciation. What else would you add to that, Paul, in thinking about returns?
No, I think you've raised some excellent points. And I think that a lot of folks don't realize that when private equity firms go out and make acquisitions, while they are informed by current comparable acquisition statistics, okay, so what are these businesses typically trading at in this particular market, for example? What they're really doing, though, is anytime they look at a business, Nick, they're applying the same mathematics that you just talked about on the internal rate of return. They're saying, okay, I have company A here, and It's a pest control business doing $20 million in revenue. I want to buy this as a platform. What can I afford? If I take this business, this $20 million business, and I model it out over the next 5 years, and I think about operational improvements, I think about growth enhancements and strategies, I think about all the fine tuning in the business that I can do, the add-on acquisitions, what can I afford to pay for it today while making sure that I get a minimum IRR of X? And so that target might be 25, it might be a 25% internal rate of return. So when they model that out, they say, hey, if I do all of these things to this business, I'm going to sell that business for X amount 5 years from now, right? What can I afford to pay for it today in order to make sure that I meet my minimal hurdle, my minimal IRR hurdle of 25%? And so you're effectively saying, I need a return of 25% as an example. Now, it could be 20%, it could be 25%, it could be 30%. Different funds are going to have different required rates of returns based on markets, based on capital size. For example, what segment of them are we playing in? Lower middle market, so on and so forth. But at the end of the day, they're saying, I've got a return parameter I need to hit. Here's what I think this business is going to do. What can I afford to pay today for this potential future? And so it's reverse engineered. You know, when I was at American Capital, that's what it was. It was literally us taking a business, modeling it out, determining what we thought it would be worth or what we could sell it for 5 years from now, and then reverse engineering it, saying, okay, what can I pay for it today in order to make my 25% hurdle rate? Done.
That's a great point. I mean, when I was a public markets investor, analyzing businesses and investing in businesses across the globe, we would do the same thing. I mean, we would essentially look out 4 or 5 years, even though it was a public market setting, and reverse engineer what the price was today that we could pay in order to generate an internal rate of return. So this is a financial concept that translates across many investment disciplines.
Yeah. From real estate to private equity, to public equity.
Absolutely.
It's a pretty standard practice, and it's used extensively by private equity firms. And again, you know, when we talk about, you know, I know on the buzz I talk about bending returns, right? And so folks being willing to step outside of their required return parameters in order to get an asset that is extremely appealing for one reason or another. But no, I appreciate the introduction to that. I think that, you know, if we think about the discussions that you and I have had over the last couple of weeks, at its core, a private equity firm is stepping into an inefficient market. Like the private markets, publicly traded, it's not particularly transparent, it's very opaque. They're stepping into these markets or attempting at all costs to avoid an auction. Private equity firms want to avoid competitive sale processes. And so part of their calculus is, if I can buy a business that's not run through a competitive sale process, if I can get proprietary deal flow, and I can acquire a business that's being sold to me by a relatively unsophisticated seller who's not doing that, and then I turn around 5 years from now and I use a very competitive process and I'm very sophisticated and I hire my bankers and they go out and they get the highest price for it. There is actually value. That's part of, we used to think about that at American Capital all the time, going into a market and doing a proprietary deal that's not shopped, where we can get it on the cheap. And then just by the mere fact that we're actually running a sophisticated controlled auction process, even if we only hold the business for a year, could we get a 30 or 40% return just by changing the process? And then many times
doing nothing else.
By doing nothing, just buying in a inefficient market and selling in a efficient market. So I think that's important though for folks out there that are considering partnering with a private equity firm. It's like, don't let them squeeze all the juice out at the end by running a formal process. You should be thinking, you know, as we talk about what private equity does, at the end of the day, it's not really a private equity playbook per se. It's really what a smart and sophisticated investor should do as a good steward of his investment. Not only the purchase and the sale process, but also all the other things that we talked about, which is mitigating risk in a business, which is making operational improvements, managing and measuring performance, focusing on growth strategies and enhancements. These are all things that you can do in your own business without partnering with a private equity firm. I think there's a lot to be learned from what these guys do.
Absolutely. Like there's the core message is that private equity folks, in order to generate those returns to satisfy the expectations of their clients, need to drive value in the businesses that they acquire. Not only do they need to drive value, but they need to try to buy them cheaply and sell them at more expensive valuations. Ideally, it doesn't always happen, but ideally. And so understanding how they go about that can be applied to anyone to increase the value of their business today. And I would also say, like, the extension of that is what you mentioned, which is the other aspect that I would add to that, Paul, is after creating value within your own business by taking some of these lessons from what private equity folks are executing in the businesses that they buy, we can also take another page from private equity in that make sure you run a controlled process when you are ready to actually go sell your business, because we know that's what private equity is doing.
Yeah. When I think about pest control alone, I think about all of the private equity firms that we at Potomac have represented over the years as sell-side advisors. For example, the No More transaction, which was a $200+ million deal. It was an acquisition that ServiceMaster made. Norvestor, a Norwegian private equity firm, the majority of the acquisitions that they did, they were buying on the cheap. There were no controlled processes, no competitive processes. They were going out and they were buying these things on the cheap. When I think about, mosquito control services, which is a transaction that Rentokil did, that in and of itself was a business that Scott Capital bought, proprietary deal flow. They came in quiet. They bought this business on the absolute cheap. They made substantial improvements over the years and turned around and sold it in a competitive process. I think about VDCI. That was owned by a consortium of small, lower middle market private equity firms, did the same thing.
I think we knew we needed an advisor if we were eventually to sell the company. And in our view, there was nobody better on the planet that we wanted to have work with us than Paul.
They didn't go out and buy it at auction. They bought it on the cheap, and they turned around, and we ran a controlled process, brought in a ton of bidders, and this thing gets played out over and over and over again. I do think people should, again, we're beating a dead horse here, Nick, to a certain degree, but it's an important aspect of it, and people should think about it.
Yeah. Could you elaborate a bit, Paul, on what type of commitments and expectations owners should think about when being acquired by private equity? And what I mean by that is, am I going to be running my business after being acquired for a year? Is it going to be 10 years, somewhere in between? And, what are they going to expect of me over that time?
Look, at its core, I would say the majority of financial sponsors, in a perfect world, what they would like to do is partner with founders of businesses. So an ideal situation is, Nick, you and I own a pest control business. We do $30 million in revenue. And we decide, hey, we're not spring chickens, but we're certainly not old. We want to continue to run this business, but we're looking to maybe take some chips off the table today. You want to buy the boat. I want to buy the plane. Like, we want to cash out a little bit and enjoy it, because, we've been investing in our business. Like, we live a decent lifestyle, but hey, we're not we haven't really cashed out yet. And it's time for us to do that. So you and I might say, hey, let's take $50 million off the table between the two of us. We still want to run this business, and it would be great to get some additional capabilities that you and I don't have. It's starting to get a little bit big. We need to bring on some serious executives, some new finance firepower. We definitely could learn a lot more about digital marketing and those sorts of things. And quite frankly, you and I have never run a business this big before, ever. So it's really time for us to get some sophisticated help. So in that scenario, we would be an ideal candidates for private equity, because they would come in and say, hey, Nick and Paul, why don't you two sell 70% of your business? We're going to write you a check for 70% of the value today. You guys collectively will own 30% going forward. You guys have done a great job. Your team respects you. You've got a great vision. You've clearly got a track record because you've gotten it from here. but you need some help, and we're the guys to help you do that. And ideally, the 30% that you two roll is going to be worth far more than the check we're writing you today for the 70% of the business. So let's go out there and triple or quintuple our investment in this business. And so that is a perfect situation. And in that situation, you and I are largely in the same roles, largely doing what we are today. Maybe we're replacing ourselves in the org chart to a certain degree. I'm doing a lot of the, operation stuff. You're doing a lot of the finance stuff. We hire a CFO, but for the most part, that's an ideal situation for private equity. That they love that sort of stuff. But there are situations where, folks will say, I don't necessarily know that I want to continue to run this business. I would love to continue to invest in it, but I really want to cash out. Private equity would certainly get involved there. There are situations where founders just want to retire or otherwise leave and do something else. Again, that's not ideal. And in that particular situation, a private equity firm might be willing to buy the business, but maybe not allow us to roll a substantial portion because they don't want passive investors. They might say, Nick and Paul, you guys are going to go off and do something else. You can roll a sliver. It's great to have your name on the cap table. We want your people to know that you're somewhat involved. You guys will be on the board. I can think of a great example of that, Jared Borg. He and his partner, Kyle, owned a company called Point Pest Control. That was it had big operations in Illinois as well as on the Eastern Seaboard. Jared and Kyle sold that business to Pesco, which is a private equity-backed pest control business. Within a 12-month period from the closing, Jared was CEO. For the first 90 days, he remained on as CEO. And then over time, he just went and focused on monthly calls and then just board activity. And up until today, it's 2 years post-closing, I think, give or take. That's about right. He's just on the board. Like that's his only. He owns a significant chunk of equity in Pesco. He's only on the board. I just got a message from him 2 days ago. He was in Alaska, right? So he's hanging out in Alaska doing that sort of stuff. So that happens all the time. And I think private equity firms can be very flexible, Nick, with regard to commitment. I think one thing that people do need to keep in consideration is that all intentions in these deals can in some way, shape, or form be translated into economics, right? And if you're an owner who's full of piss and vinegar and you really want to grow the shit out of your business and you want to roll a lot of equity, that's going to make private equity firms excited because they're like, hey, this guy's taking a lot of risk. He's super excited. He wants to roll 40% of his equity into NewCo. I am willing to bend returns here. I'm willing to pay a little bit more money than I have to partner with this guy versus the guy who's got a very similar business, but I don't really want to roll any equity at all, and I'm not too excited, and I'd rather do something else. Yeah, there's value in that business, but that's how the intentions of the founders can actually translate into real life economics, and I've seen that happen. So it's really important, I think, for sellers or folks that are contemplating this to really think about ideal situations for themselves before they even start talking to financial sponsors. Because as we talked about in earlier sessions, Nick, I mean, there's literally hundreds of these things, hundreds of these firms looking at the pest control industry, and every one of them is created equal. And I know to most people, when you sit down and listen to them, they use the same buzzwords, second bite of the apple, like permanent capital, this, that, or the other. But at the end of the day, they do tend to have different investment philosophies and different sensitivities to what you might want to do as a seller.
Yeah, no, absolutely right. I think it's also important for sellers to remain flexible and open-minded, given the amount of flexibility that can be prevalent within a private equity acquirer, or also the number of acquirers, as you just articulated. So you may have an owner who's young but a bit burned out. He's been running hard for 10, 15 years, thinks he wants to just be done. Right? But then a private equity firm likes that founder mentality that he has or she has, likes what they've created and wants them to be a part of the future. And oftentimes the person or the executive that built a business to $20 million and used their inherent skills in order to do that, those skills might not be the same skills and abilities that can take it to $100 million. Okay, so adding a partner can not only take risk off the table financially, but it can also alleviate a lot of stress on that founder with these enhanced capabilities and support of private equity in order to then take the business to the next level, whether that's through organic growth, whether it's through targeted M&A, and also then shifting that role from more of an operator in the details to more of a visionary and strategic thinker.
I think that's a great point, Nick. I mean, one of the things that folks often say to me when we're going through these processes, I have clients that'll say, Paul, I'm unemployable. Like, I don't think I can work for anyone. And yeah, maybe you wouldn't want to have a boss if you were out spraying for bugs, but you actually really love learning about M&A and you love to go out and talk to people. What if you rolled equity and the private equity firm was able to replace you on the operations side, which quite frankly, you're not that good at anyway, and allow you to really focus on the things that you are good at and that excite you? I know you're burned out, but doesn't that sound far more, well, yeah, like if I could do that, like I'm happy to get on a plane and I like to travel around. So I think to your point, like kind of figuring out what you want to do and what you're good at and what you enjoy doing versus what you don't, because it's really easy to throw the baby out with the bathwater and just say, hey, this is not going to work because I don't want to work for anyone or I'm burned out. But there might be a way for you to kind of still stay in the saddle, but still get a lot of time off and still do what you want to do. So great point.
And take financial risk off the table, yet still leave a lot of upside on the table.
I was reading a group text this morning, a client with some of the Potomac folks, and he was asking the question, he's like, if the market goes to shit, he's contemplating selling, the majority of his business, partnering with private equity and working. And he says, hey, if I sell my business and the market goes to shit, and I'm going to interpret that by meaning like valuations fall. I don't think he was talking about like the consumer market and pest control. I think he was talking about valuations. I sell my business, I partner with private equity. As soon as I do that, the market goes to shit. Am I in a better or worse position?
It's an interesting question. I would say that you're in a favorable position in the sense that you didn't have to endure that financial risk associated with you thinking your business was worth 15 times EBITDA to now it being worth 10 times EBITDA, right? Because effectively, if you're that person and you've been investing a significant amount in your business to have it continue to grow, the 99% of your net wealth is going to be tied up in that business. So selling at a 15 times EBITDA multiple, as opposed to now having multiples in pest control be down to 10 times, you're in a more favorable position because we don't know when in that scenario you paint, they're likely to go back to 15 times, if ever. I mean, that's a scenario that can happen across a decade.
And it does put you in a position to potentially do accretive acquisitions going forward, right? Or in a better position with regard to that. Yeah. You just prompted me to think about that just because you were talking about the whole risk off the table situation. I would answer that question the same way as you. Like the worst position to be in is own 100% of the asset and the market takes shit. If you diversify yourself and you're able to, sell 70%, you still hold a significant chunk, but in a perfect world, you've got a fund that's your partner that understands the capital markets better than you, and they're going to hold this thing until the appropriate time. And they're shouldering the brunt of the burden, right? They're the majority holders of that business now. So,
yeah, that's right. I mean, and also just like from the personal standpoint, like if you're the owner, and let's say you don't make any money off of your role, that 30% role that you executed in this example. If you're the owner and you had the foresight to think about what you were actually taking in cash versus what you were rolling, and you were comfortable that, hey, if this ends up turning into a zero, I know that I can generate X million dollars. Let's say it's a $25 million let's say a $25 million cash upfront deal, and based on our conversations that you can generate around $1 million of after-tax income in that scenario, and you're good with that, right? Your lifestyle can be supported easily with that amount, probably by multiples, and the role at that point is an option, right? And there's a lot of option value in it, in that you can make 2, 3, 5, 6x your money on that roll. But if not, you know what? I'm good. I built this business. I took the financial risk off the table, and now I can finance my lifestyle. And guess what? Down the road, if I want to, I can start another business.
What do you think about, Nick, when, what are important things for people to think about from a tax perspective when they're contemplating a potential equity role with a private equity firm?
So the equity role is a pretty unique situation, given some of the tools on the investment side that can really reduce taxes on an equity role in the future. So as an owner who sells their business, you're in this advantageous position in that you've received a large amount of capital or cash up front, and only a portion of that capital can be deployed into strategies that target market-beating returns, but yet they have the advantageous ability to reduce taxes on an equity role. Because if that equity becomes worth multiples of what it is today, there's going to be a large capital gain at some point in the future. And so the earlier that you can plan to offset that equity roll taxes on that capital gain, the better. Because these strategies, I won't go into all the details today, because frankly, they're also, proprietary, but those strategies are cumulative. So if you plan early, you can do a lot of damage in cutting the taxes on that equity roll.
And when you say plan early, how early do you have to plan?
If you're planning a year in advance, you can make a lot of headway. But if you plan 2, 3 years in advance, you can make even more of a dent in that capital gain on the equity roll.
Gotcha. Got it.
And then not only that, but oftentimes owners, after they sell their business, they're going to have a large ordinary income component to their financial situation. So they're receiving a salary from the private equity company or the underlying pest control company. They're receiving their salary. But now that they have this large pile of money that's invested in a combination of stocks, real estate, fixed income, private loan funds that can generate 10+% income, you now have a lot of ordinary income. And I can tell you from experience, business owners, entrepreneurs, they're not used to paying ordinary income taxes, okay?
Yeah.
Because there's obviously a lot more tools when you operate a business and you're investing in that business to defer taxes and to reduce your taxes. But all of a sudden you have this big ordinary income tax hit, which is very uncomfortable. Using some of these same investment tax mitigation tools in combination with one another, there's actually situations now where you can substantially reduce the ordinary income tax burden. I'll tell you about a situation I had recently, which was a $20 million portfolio that was invested in a combination of treasury bills and private loan funds. So this is like a current situation that we had. And this portfolio that had been created was generating around, $1.4 million in pre-tax income from those investments, which are currently high-yielding investments. But on an after-tax basis, given a 34% effective tax rate, that dropped all the way down to about $920,000. So a substantial difference versus $1.4 million. And again, for business owners, that's a painful tax bill. Okay. Yep. So by taking just $5 million of that $20 million portfolio and investing in a combination of investment tax strategies, we were able to actually increase the after-tax income in that situation to over $1.1 million. So almost over a $200,000 after-tax income uplift. Okay. So it's not always what you make pre-tax, it's what you keep after tax.
That's why I'm in Puerto Rico. I don't have to think about those things.
Yeah, you don't even have to bother with that. So I'm very jealous, as always, of that. But most people do.
Well, Nick, look, it's been an exciting time, obviously, over the last 5 years with private equity investing, not only in broader home services, but in pest control. I think here in 2024, by the end of the year, we'll see an additional 2 or 3 private equity firms enter the North American market. I suspect there'll probably be well over $1 billion in pest control M&A transactions with private equity in the year 2024 in North America. So it's a very, very active market. As I said at the beginning of our discussion, right now 90% of our deals are with financial sponsors, either platform acquisitions or add-ons. I know a lot of folks out there have a ton of questions. So now we've come to the end of the formal series, but in the coming weeks, we're going to answer each individual question that comes through, and we'll put them up here on the channel. So again, pe@potomaccompany.com. Send Nick and I your questions, and we'll get back on and answer them.
Yeah, looking forward to that, Paul.
Thanks, Nick. Talk soon, bud.
Okay, see you soon.